Okay, so welcome to chapter 7, which really kind of um, splits the topic of the chapter between something called fraud and internal control, which we're going to focus on, and talks about cash in relationship to that. So let's go ahead and start today with objective one about what fraud is and internal control measures that companies need to put into place to protect against fraud. And then we'll look at the same internal control measures as it relates to cash, because cash is the most vulnerable asset. Let's face it, if you saw a $50 bill on the ground and you picked it up, very rarely you're going to say, "Hey, did anyone lose $50?" Because you just don't know if who owns it, right? Um, so basically speaking, cash is a very vulnerable asset to have, because how do you prove ownership and how do you prove someone stole it? And so that's really sort of important to identify. Then we're going to look at the bank and the bank account, because the bank's the only other place that knows what's happening with your cash. You know what's happening with your cash because you're using your cash and putting money in, taking money out, writing checks, using debits, blah blah blah. But your bank also has a record of your cash, and so it should say the same story in essence. And then we'll look at how cash is actually reported and used in a business. So that's the broader framework. First step is looking at fraud and internal control principles. So first of all, fraud. This is a limited definition because fraud technically is any type of, you know, deliberate lie, misrepresentation, other types of things like that. It's a broad topic for sure. But in here, we're narrowing it down to a dishonest act by an employee that benefits them, but at the cost to the employer. Right? And so, unfortunately, um, fraud happens. Fraud happens. And it's one of those types of things where businesses have to do everything they can to hire people that are less likely to commit a fraud against them, and also make sure that there are procedures and policies in place that help prevent fraud and keep everybody as honest as possible in the business setting. But what actually contributes to fraud? Your book goes on to three particular factors. Look at how many people actually handle cash in a business. Think about some of the jobs you've had where you might have been a cashier or waiting tables and handling cash, and other areas where you're actually handling cash for the company. Well, that basically is a an opportunity to take things. Look how many people actually have access to the other assets of a business, like inventory or supplies or things like that. That opportunity is there because we businesses trust employees to handle certain assets as part of their job. Another factor is any financial pressure that that person might be having. I mean, we already understand how tight people's budgets are, even when people have jobs. Making the rent and paying for transportation and healthcare, education, and food, and blah blah blah. I mean, it all sort of adds up, and people are more and more people are living paycheck to paycheck, and so we do understand that there's financial pressure there. Not to mention folks that might have lost a job or hours being cut because of the pandemic. You add to that some of the very human things that we have as frailties, like addictions, whether that be to alcohol, um, or cigarettes, or other smoking products. Um, uh, Shopping. Some people are just basically they shop for no reason just because they're bored. Gambling, um, or other uses. So when people are sort of hooked on certain things, that also increases the financial pressure on them. But just because someone is working for you and they're handling cash or other um, vulnerable assets, and they do have financial pressures on them personally, doesn't mean they're going to be taking your stuff. The third factor has to come into play for actually that to happen, the rationalization piece. And rationalization basically is convincing yourself that doing something wrong is right. Okay. And so you understand that that's the cash that the customer has given to you for a payment of something that your company is providing. You know that the supplies are there for the business purposes. The inventory is there for the business to sell. You already know all of that stuff. But the rationale comes in where it's like, well, this is a $10 billion company. They're not going to miss $100. This is this is a multi-billion-dollar organization. They can live without this. They can live without that. Or worse, you're angry at them. I hate my job. They're not treating me well, and I deserve this. I deserve to take this money. I deserve to take this piece of inventory. I deserve to take this, that. All of that is rationalization because, in essence, you already learned in kindergarten you're not supposed to take stuff that doesn't belong to you. We already know that, right? A long time ago. But that rationalization basically twists it. And between these three factors coming together, that basically is when fraud occurs. The government has an interest in making sure that publicly traded companies, publicly traded corporations, do everything that they can to present their books accurately, safeguard their assets, etc. And so the Sarbanes-Oxley Act actually requires corporations to put into place a system of internal controls that guards against fraud by employees and managers. Okay. Um, Very specifically, corporate executives and members of the board of directors need to make sure and testify through the annual reports and other things that these controls are in place, they're reliable, they've been effective. Furthermore, an independent auditor comes in to make sure and attest to the fact that the company has put in these systems of internal controls and that they are doing as good a job as possible in preventing fraud from occurring. Okay. The Sarbanes-Oxley Act also created what's called the Public Company Accounting Oversight Board, which is basically the administrative arm of the law that makes sure these things are being implemented appropriately. So, what's the purpose of internal control? What's it sort of all about? The most important thing I can tell you about internal control is for companies to make sure they're safeguarding their assets, particularly those that are most vulnerable, like cash, right? Supplies are vulnerable. Um, I would say inventory is vulnerable. But it's amazing, equipment could possibly be vulnerable. Furniture and fixtures, other types of things could be vulnerable to fraud. Someone might decide, I need these table and chairs. It doesn't belong in the boardroom, belongs in my living room. And it's gone. So, basically speaking, anything can happen. So the purpose of internal control is to make sure they're doing everything possible to safeguard the assets, particularly, like I said, cash is the most vulnerable asset to protect. Um, Internal controls also increase the accuracy of the accounting records and thus makes them more reliable. Because managers are forced to deal with setting up procedures, they're making their operations more efficient. And thus, actually, the business is benefiting by having internal controls in place. And of course, they need to make sure that they're in compliance with Sarbanes-Oxley and the laws and regulations. Okay. So there are some components that we're going to be looking at and dealing with regarding the um, internal control issues, including the control environment, risk assessment, control activities, information and how it's communicated, and monitoring how the system is working. So first things first, let's take a look at the activities that need to sort of be in place by companies to make sure that internal control is being done. So one is something called establishment of responsibility, and that's to make sure one person is responsible for a particular task. And so if anything is missing, we kind of know who to look at first, right? So this happens here. Look at the drawing here of you have one cashier who is taking their drawer out, another cashier coming in and going to be putting in a separate drawer, right? So by having your own cash drawer, you know what person is responsible for what happened to that particular cash. And that's an important part of internal control to establish that responsibility. Okay. Part of it too is to limit access to certain personnel um, and identifying those either through codes or other types of things where you know who's responsible for being in the warehouse or in other types of areas. And so if anything is missing, there's this activity is in place to help the company figure out where the fraud happened. Okay. Another thing is to separate duties. So one particular individual doesn't control too much. So if you control too much, you can hide things. You can get away with things because only you know about it. But if you have more than one person who's in part of the process, then other people know if something is going wrong. Okay. So this idea here is different responsibilities. Individuals should be responsible for different responsibilities in the process. So here they have an example of this employee who actually maintains the books that show the company's cash balances. And then there's another employee who actually is maintaining the custody of the physical cash. Obviously, their records should equal, right? And so that's how they establish some accountability in that record keeping system. Okay. Better still is if everything is documented. And so another internal control principle that companies often use is making sure everything is documented, okay, and accounted for. Sometimes these documents require signatures, etc. But if you don't have the document, you can't get the supplies, or you can't get this, you can't get that. And so that's important to make sure things are documented accordingly. And then you've already kind of experienced a lot of physical controls. I mean, I think what everybody's experienced at one point in time in their life as an employee is you needed to keep track of your time. Some businesses just used to have the punch in clocks, but of course you could punch in for someone else, right? And thus you're stealing time. That's also fraud because you're stealing time. But for the most part, now they've gone through a system where some businesses are small and monitor their activities for time on a personal level. Some businesses give employees codes. They have to either call in or punch in a number or swipe a card or something, an ID, to indicate to the system that they have arrived and they are here to work. And then when they leave, they also do the same thing. And so again, this is to avoid stealing of time, which of course, if you only worked 20 hours a week, but your time card says you work 25, you're technically stealing 5 hours of money from your company. So that's why it's an internal control activity involved here. Um, We've all been in stores where the inventory is tagged, right? There's a whole bunch of tags on it. Some are even behind, locked doors, glass locked doors, et cetera. So you can see it. Um, and this is all, again, to safeguard that particular asset, because it's very, very important to have those safeguards in place. You might also have experienced the fact that all companies have various alarm systems or other types of security systems, not just for break-ins, but for shoplifting. So, if you walk out, you hear the beep, 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 beep at the door. Either someone paid for it and they didn't remove the tag, or they didn't pay for it and they're running out the door, right? So, either one, it's meant to, the alarm is meant to be an internal control activity to stop a stealing of an asset, right? There are a lot of you know places where, in order to get in, you need a pass key, you need a fingerprint, you need an eyeball scan. That's also true for cash registers too. You can actually have a particular pass key or a password or an identification in order for you to use it. And then once that transaction is done, you can either log out or automatically um, logs you off. Certainly, warehouses are locked. There's only a certain amount of people who can get into the inventory. There's records of that inventory, et cetera, to keep that safe. And of course, companies also have vaults, safety deposit boxes, and other things for cash, and only a few people can get in, right? And so that's how they control things. Uh, the best thing that they can do too, if the company is big enough, is when you look at employee A, who's maintaining the records for cash, and employee B, who's maintaining the actual cash, there should be someone who knows about the system, like the assistant controller here, who can simply verify that things are good. Right. So that's an independent internal auditor of sorts, someone who then can find discrepancies and say, hey, there's something fishy going on here. Human resource controls are extremely important internal control activities in a number of different ways. So, first of all, you are going to, if you get a job where you handle cash, you are going to need to be eligible to be bonded. Okay. So here we're talking bond in terms of insurance. No, we're not talking 50 shades. And so to bond an employee means you're able to purchase an insurance policy on the employee in case of theft, in case of theft. And thus the insurance policy covers that risk. But in order for that insurance to be given to that employee, you have to prove various things that employee is a safe bet, and the insurance is simply a practical matter. So employees that have the background checks that come up with, they were guilty of stealing lots of stuff, you know. Well, if they are still this, they're getting older and older and they still don't understand you're not supposed to take things that don't belong to you. It's going to be very difficult to hire that person because there's never going to be a way to bond them. There's never going to be a way to insure them. No insurance company's going to want to take that risk um, without costing them an arm and a leg. And why would a business do that? So businesses can deny applicants for certain jobs based on things in their background that increases the risk that they might commit a fraud. Um, and so that's something that they can use to deny applications or um, even get rid of people, right? You can also, one of the other things you can do too is make sure that employees are not very comfortable just doing one thing, because they might figure out ways in which to commit a fraud. And so move them around to different duties or rotate their duties, make sure that they're never that comfortable in one place or bored to then start scheming to do something. Um, and rotating of those duties does help because the new person that's coming in will learn a system and see if there's anything wrong and be able to report that to the manager, like, well, this doesn't make sense, this isn't working out, and that alerts the company that something might have been wrong with that. That's also the issue with vacations. When you're not there, things should be able to be the same. And if you're not there and all of a sudden things are different financially, there may be a fraud. Here's a quick example. I used to live in Boston, and there's a wealthy suburb just west of Boston called Brookline, not like Brooklyn, but Brookline. And back in the day, we had to feed the meter. Every time you go to Brookline, you had to feed the meter because there was pocky meters everywhere. And of course, we had what we called, meter maids at that time. Not a very good word or job title today, but at that time, that's what they were called. And they would collect the money. They would also give tickets to people that did not pay their fee to park in a certain spot. And one of these lovely ladies uh, was tracked because every time she was on vacation, um, they collected more money on her route than when she was working. When she was working, they collected X dollars, but when she wasn't there on vacation that week, they collected X plus Y dollars. And that happened every single time she was away. So they put an investigation together, and they were able to show that actually she had a lot of different cash deposits in her savings account because she was basically skimming. While she was there, she was taking coins for herself because physically that's how it was done. Um, and so, if it weren't for if it weren't for those vacations, that human resource control, they would have never noticed the difference, and they would have never been able to identify the fraud. And so, basically speaking, there's a lot of principles of internal control, and it's important for you to understand them. So, your book has a series of frauds that they explain, and they want you to identify what's missing. So we're going to do a couple together here, but this is part of your reading. So here we have Maureen Fergali. She was a training supervisor for claims at Colossal Healthcare. And she ran the claims processing training program for trainees. But as part of this training program, she would have the trainees create fictitious claims that were sent to accounts payable. And then after the trainings class was over, she would notify accounts payable that, hey, these claims number 1, 2, 3, 4, and 5, these were fictitious. They're based on my training, on my trainees. And thus, accounts payable would not pay those things. Well, she's the only one who knew what was going on there, right? So basically, there were times she did not inform accounts payable about those fictitious claims. Those claims were made out to entities that she controlled. And thus, when accounts payable sent the checks, they didn't know they were being sent to her, and she cashed them in her account. She took $11 million, which is a colossal amount of money, and it might make you sick if you're a healthcare system. But clearly, the missing control was no one else was responsible for that. She had full authority for creating those claims that were false, putting them in the system, and approving them, and sending them to accounts payable all by herself. And so she should not have been able to do all of those types of things. There should have been a different way of breaking up that responsibility so that fraud wouldn't have happened. Also, one of the things too is she should have also been on a separate system, not on the live company system that actually processed the claims, but a dummy account that would have processed it into an account saying, okay, these are the trainees practicing and not real bills to pay. All right, here's another one. Larry Fairbanks was a big cheese at Aesop University here. And this person was allowed to make purchases of under $2,500 without any approval from anyone else. Of course, as an assistant vice chancellor, you're pretty high up in management. So that was the trust level they had here. Sadly, Larry liked antiques and other collectibles, so he bought a few things for himself. And basically, he replaced the vendor invoice with a fake invoice that he created. Okay. And the ones that he created, he did a great job because he knew how the system worked of creating descriptions that were perfectly in line with all the other purchases and thus could have easily gotten paid. Okay. So what was going on there? Larry had a hell of an education. Get it? Aesop University. Because he took, who says education doesn't pay? $475,000 worth of, that's a lot of money. That's a hell of a lot of antiques there, Larry. And again, here, Larry had control of the whole thing. There was no segregation of duties. He was able to order things. He also received those things, and he also was in charge of that invoice that they received. So he had control over all of that processing. That should have been broken up. Someone else, or maybe more than one other person, should have been involved in that particular process to stop that fraud from happening. Okay. One more. And there's several more, as you see, but we're going to do one more. So here, Angela was the clerk, accounts payable clerk for this construction company. And she was the one who issued and prepared checks to that company's vendors. And she also reconciled the bank statement, okay, for that company. So this is her fraud. She wrote checks for the company for costs the company never had. Okay. A supervisor would then approve and sign those particular checks. Then she would actually white out the payee line and change it to her personal account and put it in her bank. Okay. Now it would have shown up on the bank statement because everything you see, it's in the bank statement. Okay. And basically speaking, she was able to conceal all of that because she was the only one who reconciled the bank account. So no one else saw those checks coming in and out or being cashed. And thus she was able to get away with a little bit. So a little bit more than $500,000. That's you can construct a lot with that type of cash, right? And of course, again, she was the only one in charge of everything in that process. There was nobody else involved, no segregation of duties, and so no one else knew the frauds were happening. Okay. And the same is true for all these other frauds that you're going to be reading about. Okay. There's always some missing control that perpetuated the fraud, and it cost lots and lots of money for these companies, sadly. Okay. So that's that. So the Sarbanes-Oxley Act, SOX, actually helps and boosts the role that human resources has in making sure fraud does not occur. One of the things that you need to know under SOX too is that the company needs to keep track of an employee's degrees and certifications. And so you can't state that you have a degree or a certification without providing evidence of that. And guess what? HR is going to be asking for that, and they have to. Okay, it's part of the law for a public company. It's part of the law, but all companies will do it. And so basically speaking, companies also, or they have to compile an organizational chart um, as well. That's part of the other thing that they need to do, because they have to figure out who's reporting to who and how things could be segregated and controlled better. Okay. Um, it's interesting because one corporation did that exercise. There was a large corporation, 17,000 people that worked there. They found out 400 people didn't report to anybody. Um, so that's a lot of people that are doing their own work and no one knows about it. So that's really, really, really important. Um, the law also mandates that if an employee has a complaint, such as an unfair firing or there are financial issues going on at the company, it's the HR department that needs to refer that and to legal counsel. Okay. So it's important to understand this issue is internal control is a big part of the financial issue safeguarding of the company, and that's why it's in accounting. That's why you're going to need to know about it. So there are some limitations, of course, of implementing all these internal control measures. Certainly, the size of the business, I think, is really practical here. Some companies are very small, where you have one or two people that do everything, and so how do you put in controls there? Very, very difficult to do that. Of course, putting all these controls in place costs money. And of course, you got to understand the benefit is to safeguard the assets and keep the records of the company accurate. So you have to look at the costs and those benefits. The costs have to be reasonable. And then there's us, the human element. There's nothing stopping us, even with all these things in place. There's nothing stopping people from doing bad things, right? If they want to. And so that's part of the free choice that we have. When we show up to do something. Um, and unfortunately, that's always going to be there, and that's a limitation of all these things. Okay. So your do it exercise number one looks at several situations and provides you with what control activity would have been best to stop it. And so that's something you're going to have to do, and you'll see that as a lot of your homework. But while we're on internal controls, let's look at internal controls when it comes to cash, because this is very, very important. Okay. Cash is the most vulnerable asset because how do you know who owns it? Usually we know who you can prove you might own supplies because you might have the invoice, you might prove you own inventory, you prove you can own equipment because you have all those papers. How do you prove you own the cash? Cash is it's a very, very vulnerable, the most vulnerable of all assets, and thus it's one of the things that can get stolen easily, where fraud can happen, right? So when a company is receiving cash, there needs to be certain controls in place, right? So there has to be someone who's going to be responsible for receiving that cash. There should be documents indicating that cash was received. Maybe that's a bill of sale, right? Or a receipt or something like this. And there has to be some other person who's involved in keeping the cash versus counting that cash, things like this. There's got to be more than one. So cash receipts are extremely important to understand that there's a lot of controls need to be in place, right? Human resource controls, we talked about bonding, making sure that there's an independent internal way of verifying things and that there are physical controls in place to safeguard cash, usually in safe bank deposit boxes, things like this. Okay. All very important. Another thing they look at is, over-the-counter receipts. It's very important to make sure that we segregate the actual record keeping from the physical custody of cash. And so here you have, a clerk who enters the sales and counts the cash, sends it to the cashier. The cashier counts and prepares that slip. That slip will be part of the bank, but it also goes to the accounting department. Supervisor looks at the cash register tape, make sure everything is there. That gets reported to the accounting department as well. So these things are in place for a reason, right? Cash is vulnerable to these things, and we need to have controls in place. For receiving cash in the mail, checks in the mail should be opened by at least 2 people. Endorse checks right away, that they're for deposit only, so no one else can sign it and put it in their account. Very, very important that these types of things be followed. Okay. In terms of actually paying cash out, cash disbursement, right? So it's better to have a record of it. So you either want to pay by check, so you actually see you have a record that you can prove went to the right person or was fraudulently cashed, right? Better still, ETF, so you control exactly where the funds are being transferred to. Those are much better than actually continue using cash. But unfortunately, we have a lot of companies that are cash basis. They only take cash. Unfortunately, I think they've been hurt a lot with the pandemic because no one wants to handle cash because of the possibility that COVID lies everywhere, even the cracks of a dollar bill. But nonetheless, cash is still very common, particularly for a lot of smaller businesses. Okay. So this is part of it. So again, whenever you're dispersing cash, you want to make sure things are properly documented. You have to make sure that there's specific personnel that are authorized to sign these checks or approve what businesses we're doing business with. There's got to be a way in which we are segregating the duties. And so we have people who are approving things that are different than the people actually cutting the checks, that are different than the people actually signing those checks. So I think those are very, very important. Again, having some independent verification, making sure they're stored physically, and making sure you have everything controlled and insured regarding your people that are involved are very, very important in cash disbursement. Okay. Most of the time they'll use some type of a voucher system, an authorization form that is prepared to verify and keep track of what the expense is. And then there's usually multiple signatures to that before it's actually paid. Okay. But sadly, there are lots of ways in which employees still steal from their employers. Certainly misappropriation of an asset, which basically, cash in the pocket, or, ghost employees, personal purchases. This fraud is the most common, as it says here, but it doesn't cost the company as much as the others. Corruption is a problem, right? Because we're human. So we can be greedy, subject to bribery, illegal gratuities, extortion. Very, very incredible thing. And then, of course, you've seen it in lots of financial companies where their financial statements are fraudulent, and it leads to significant losses. Okay. Financial statement fraud in this particular report of fraud examiners shows that even though financial statement fraud is the smallest in terms of the percentage of frauds that are done, it's certainly the costliest of all of them. Okay. So that's your do it exercise number 2, and that's good. I'll take a break with you here. We'll come back to our major class here and ask if there's any questions. But you see, it's interesting. It's a different way of looking at it.